Hello champions, in this session we are going to do a super quick revision of your entire returns chapter. Point number 1, if the assessee wants to file ITR on time, what is a 139(1) due date? By when should the assessee file the ITR if he is filing it on time? 3 due dates we have over here: 30th November 25, 31st October 25 and 31st July 25. 30th November 25 will apply to those assessees who have specified domestic or international transactions, that is your transfer pricing assessees. 31st October 25 will apply to 3 assessees. Which 3 assessees? Number 1, to all companies. Number 2, to all assessees to whom audit is applicable. Number 3, listen to number 3 carefully. If there is a firm can be partnership firm or LLP. If there is a firm, for that firm audit is applicable. So that firm will get fit under the second point, guys. For that firm, the time limit will be 31st October. That firm's partners, whether active partner, whether sleeping partner, doesn't matter. For those partners also, the time limit will become 31st October 25. Understood? If for the firm audit is applicable, for that firm anyways the time limit will be 31st October because that firm is an audit assessee. That firm's partners, whether active partner, whether sleeping partner, doesn't matter. Even for those partners also, it will be 31st October 25. Okay? For all other assessees, 31st July 2025. Alright, this was your first point. Then comes my second point. If the assessee does not file the ITR on time, that is if the assessee files the ITR late, which we call as a belated return. For belated return, what is the time limit? The time limit is 3 months before the end of the assessment year. So for our examination, our previous year is 24-25, assessment year is 25-26, guys. So the end of the assessment year will be 31st March 26. So this minus 3 months will be 31st December 25. So if the assessee wants to file ITR late, belated return, the latest date by which assessee should do the filing will be 31st December 25. Okay. Then if the assessee wants to revise the return, can the assessee revise the return? Yes. If the assessee has filed ITR on time, it can be revised. If assessee has filed ITR late, even that can be revised. If assessee has already revised the return, even that ITR can be revised, which means every income tax return can be revised. Whether it is a return which you filed on time, whether it is a return which you have filed late, whether it is a return which you have already revised, doesn't matter. Every ITR can be revised, but however, there is a time limit by when you should revise the return. Same time limit, guys, 3 months before the end of the assessment year, so 31st December 25. So whether it is belated return, whether it is revised return, the time limit is the same, that is 31st December 25, 3 months before the end of the assessment year. Okay, now is there any limit? How many times can you revise the return? Is there any limit? There is no time. There is no limit on the number of times that you can revise. There is only a time limit. Time limit is 31st December 25. But before 31st December 25, any number of times I can revise the return, no problem. Okay, what if I want to revise the return after 31st December 25? What if I want to file the return after 31st December 25? Only one option you have: go to updated return. Alright guys, so 3 points we've discussed. Now come to point number 4, a very interesting point. See, listen, if my original ITR was under the default regime, okay, original ITR is as per the default regime. Now if I'm revising this ITR, can I change the regime into normal regime? No, it is not allowed. If my original ITR is as per the default regime, my revised ITR also should be as per the default regime only. I can't change the regime. But if my original ITR was as per the normal regime, my revised ITR can be as per the default regime. It is allowed. Understanding? If my original ITR was as per the normal regime, in my revised ITR I can change the regime and I can say I will now follow 115 BAC. This is allowed because of obviously because the government wants more and more people to follow 115 BAC. So if your original ITR was in 115 BAC, your revised ITR also has to be as per 115 BAC only. But however, if your original ITR was as per the normal regime, then your revised ITR can be as per 115 BAC. That shift is going to be allowed. Okay. Then comes the 5th point. What will happen if you file the ITR late? What are the consequences of filing ITR late? Very popular 4 marks or a 5 marks straightforward theory question. What are the consequences of filing ITR late? There are totally 6 consequences of filing ITR late. The first consequence is that you cannot carry forward current year losses. Current year losses, you can do intra-head adjustment, you can do inter-head adjustment, but you cannot carry forward the current year losses. However, there's an exception. Loss from house property, your unabsorbed depreciation, unabsorbed capex on scientific research, unabsorbed expenditure on promotion of family planning, all this you can still carry forward. Even if you file ITR late, all this you can still carry forward. So loss from house property, unabsorbed depreciation and all this you can still carry forward. Other current year losses you can't carry forward. Now here you have to be a little careful. Okay, tell me. Assessee has filed ITR late. Can you bring forward earlier year's losses to the current year and adjust? Yes. Can you carry forward these earlier year losses to the next year? Yes, you can. Can you do an intra-head adjustment of the current year losses? Yes, you can. Can you do an inter-head adjustment of current year losses? Yes, you can. So what you can't do then, you only can't carry forward current year losses to the next year. That only you cannot do. So point number 1, if you file your ITR late, is earlier year's losses affected or is current year loss affected? Only current year loss is affected. Point number 2, current year loss also, intra-head, inter-head you can still do. Only thing is you can't carry forward to the next year. Okay guys, but still loss from house property you can still carry forward. Unabsorbed depreciation also you can still carry forward. Okay, then comes the second point. If you file your ITR late, you cannot enjoy chapter 6A part C. In our syllabus we have 3 chapter 6A part C sections guys, 80 JJAA, 80 QQB, 80 RRB. These 3 sections you cannot enjoy if you file ITR late. Chapter 6A part B, other sections, 80C, 80D, 80 TTA, all that you can still enjoy. But these 3 sections, chapter 6A part C alone you cannot enjoy. Then point number 3, if you file ITR late, you will have to pay section 234F fees. How much is the fees? It depends upon how much is your total income. If total income is up to 5 lakhs, the fees is going to be 1000 rupees. If total income is more than 5 lakhs, then the fees is going to be 5000 rupees. Then point number 4, if you file your ITR late, you will also have to pay 234A interest at the rate of 1% per month or part thereof for the period of the delay. 234A interest 1% per month or part thereof. Like for example, let's say you were supposed to file the ITR on 31st July 2025. This was your due date to file the ITR. But you filed the ITR on 1st December 2025. Now you will have to pay 234A interest for how many months? See, what is the period of delay over here? August, September, October, November and 1 day of December guys. So the period of delay is 4 months 1 day. So we'll have to pay interest for 5 months. Even a part of the month we will count as full month. So in our example we'll have to pay interest for 5 months. Okay, this is the 4th consequence. 5th consequence is that if assessee files ITR late, assessee has no option. Assessee will have to do the computation as per the default regime only. Assessee cannot follow the normal regime. That is, the computation will be as per 115 BSE. And the 6th consequence, the last consequence is that 10 AA tax holiday assessee cannot enjoy. So there are totally 6 consequences of filing ITR late. Point number 1, assessee cannot carry forward current year losses. Point number 2, chapter 6A part C you cannot enjoy. Point number 3, 234F fees you will have to pay. Point number 4, 234A interest you will have to pay. Point number 5, you will have to file the return as per default regime only. You can't opt out. You can't do the filing as per the normal regime. And lastly, 10 AA tax holiday will not be available. Okay, I guess there was a small problem. The camera had stopped working. I hope it's fine now. So coming to the next point now, my 6th point in our returns discussion. I have a small situation for you over here. Listen to me very carefully. One explanation itself you will understand. Let's say my 139.1 date was 31st July, okay? And I filed the ITR on 1st July, which means I filed the ITR on time, guys. Then I want to revise the ITR on 30th December 25. 30th December 25 is fine because I just told you that we can revise our ITR on or before 31st December 25. I am revising on 30th December, which is before this date, guys. So in this revised ITR, I want to declare a business loss of 1 lakh rupees. Can I do that? Yes. In revised ITR, you can declare losses, no problem. Okay. The problem is only in updated return. In updated return only you can't declare loss, but in revised return you can declare a loss, not a problem. Okay. Now the question is, can this business loss of 1 lakh rupees, can this be carried forward? See, the question arises because when are you declaring this loss? You're declaring this loss on 30th December 2025, which is after the 139.1 due date, guys. And just now we learned that if we file our ITR late, after 139.1 due date, we can't carry forward current year losses. So I am declaring this loss on 30th December 2025, which is after 139.1 due date. So can I still carry forward the loss? The answer is yes, I can still carry forward the loss. The reason is, whenever I revise my ITR, the revised ITR replaces the original ITR. So it is as if I have declared the loss on 1st July. We are creating a legal fiction over here. In reality, we have declared the loss only in the revised return only on 30th December 2025, but we will treat it as if it was, declared on the date on which you filed the original return on 1st July. 1st July is within 139.1 date. So it is as if you have declared the loss within 139.1 date. So yes, you can carry forward. Understanding. So here in this situation, I just tried to combine two concepts. Concept number one is that you can carry forward current year losses only if you file ITR on time. If you file ITR late, you can't carry forward current year losses. And the second concept which I've combined over here is that once you file a revised return, once you revise the revised return replaces the original return. So it is as if you have declared losses on 1st July itself, in your original return itself. So 1st July is within 139(1) date, it is within 31st July. So yes, I can carry forward the loss. Okay, then comes my 7th point, self-assessment. See, I want you to straight away come to this chart over here. You compute your tax liability, guys, on the basis of the slab rate. Then you subtract 87A rebate. You check if surcharge is applicable. You subtract marginal relief. Then you add cess. After all of that, what you get is called as tax liability. From that, we will subtract TEDS, TCS credit, and the net number is called as assessed tax. From this, we will subtract advance tax paid, and this is called as tax payable. So be careful in the examination. If they ask you to find tax liability, you will stop with the cess. Once you add cess, the number you get is called as tax liability. You will stop with that. But if they are asking you for tax payable in the examination, then you will first subtract TDS, TCS credit. You will get assessed tax. You will subtract advance tax paid, and you will get the tax payable number. Okay, then listen to the next point, verification of ITR. I have 6 to 7 points over here, extremely important. It's been a very long time since we have tested this in the examination, guys, so be careful. See, if the assessee happens to be an individual, assessee he himself will verify the ITR. If he is unable to verify the ITR, then his agent can verify. If he's of unsound mind, then his guardian will verify. So either I myself will verify, but if the individual is unable to verify, his agent will verify. If the individual has become of unsound mind, his guardian will verify. Point number 1. Then comes point number 2. If assessee is a HUF, then the Karta of the HUF will verify. If Karta is unable to verify, then any adult member of the HUF can verify, male or female, doesn't matter. Then point number 3. If assessee is a company, managing director of the company will verify the ITR. If he is unable to verify, some other director can also verify. But however, if the company is going through the winding up process, then the liquidator will verify. Okay. Point number 4. If it's a partnership firm, the managing partner, the main partner, he will verify the ITR. If he is unable to verify, any other major partner can verify. Sometimes we admit minors to enjoy the benefits of partnership firm, right? Those minor partners can't do the verification. Any major partner can do the verification. Alright. Then if it's an LLP, of course, designated partner will verify the ITR. If he is unable to verify, any other major partner. The last 3 points are very important. Be careful. Local authority, principal officer will verify. Political party, CEO will verify. AOP or BOY, any member will verify. Okay, guys. So these are 6 points with respect to verification of ITR, that who will verify the income tax return. Extremely important. I'll point out some important points for you. HUF, Karta will verify. If Karta is unable to verify, any adult member can verify, male, female, doesn't matter. Then, local authority, principal officer. Political party, CEO, AOP or BOY, any member can verify. Okay. Then, in what situations ITR has to be filed? Every assessee doesn't have to file ITR. There are certain situations, only if assessee falls under any of these situations, only and only then assessee has to file ITR. What are the situations? Number 1, if the assessee happens to be a company, every company has to file ITR. If the assessee happens to be a firm, partnership firm or LLP, doesn't matter, every firm will have to file ITR. So every company, every firm, doesn't matter what their income is, every company, every firm has to file ITR every year. It is mandatory. The whole drama applies only if the assessee happens to be an individual HUF, AOP, BOY or AJP. For these assessees, guys, we have 11 situations. If the assessee falls under any of these 11 situations, only and only then we have to mandatorily file ITR. Let us have a look at the 11 situations one by one. The first situation, the GTI of the assessee. GTI, guys, not total income, GTI. GTI, add back the 54 series exemptions, find the total number. Is it more than basic exemption limit? If yes, that assessee has to file ITR. Gross total income, add back the 54 series exemption, find the total income now. Is it more than basic exemption limit? If it is more than basic exemption limit, assessee has to file ITR. Point number 2, if assessee is an ROR and assessee is having a capital asset outside India, be careful, capital asset. So like for example, if the assessee is an ROR, but if he has a car outside India, then it will not get fit under this point. It should not be personal effect, guys. It should be capital asset. So if I'm an ROR and if I have a capital asset outside India, like I have a house outside India or I own shares of a foreign company, so in that case I become an ROR and I have a capital asset outside India, I'll have to mandatorily file ITR. Then if I'm an ROR and if I have an agent outside India, basically I have a signing authority outside India, I have to mandatorily file ITR. Then we'll check the total deposit in the current account. If the assessee has totally deposited in the current account more than 1 crore rupees, that assessee has to file ITR. Then we'll check totally how much has the assessee deposited in his savings account. If the total deposit in savings account is at least 50 lakhs, that assessee has to mandatorily file ITR. Then, if the total electricity expense, total of the entire year, guys, total electricity expense of the entire year is more than 1 lakh rupees, again that assessee has to file ITR. If the total foreign travel expense of the assessee is more than 2 lakh rupees during the entire year, again assessee has to mandatorily file ITR. Are you noticing, guys, all of these limits are per annum limits, guys? They are not per transaction limit. All of these limits are per annum limits. Okay. Then and by the way, foreign travel, who is traveling? Doesn't matter who is traveling. Doesn't matter whether assessee is traveling or not. That doesn't matter. What matters is assessee is incurring foreign travel expense. Whether the expense is for himself or for anybody else doesn't matter. What matters is assessee has incurred foreign travel expense. If it is more than 2 lakhs in the entire year put together, then that assessee has to mandatorily file ITR. Okay. Then comes the next point. If assessee is carrying on a business and the turnover of that business is more than 60 lakh rupees, or if the assessee is carrying on a profession and the gross receipt is more than 10 lakh rupees, then even in this case assessee will have to mandatorily file ITR. Then comes our last 2 points. If assessee is a senior citizen or a super senior citizen, we will see the TDS TCS credit. Is it at least 50,000? If assessee is not a senior citizen or a super senior citizen, we will again see the TDS TCS credit. Is it at least 25,000? So if the assessee comes under any of these 11 buckets, then for that assessee it is mandatorily required to file the ITR. Okay, see, one last time, have a look at these situations one last time with me. And before we do the last revision, I want you to notice one small thing. Everywhere the limit is more than, okay, but in these 3 places alone the limit is more than or equal to. TDS TCS point more than or equal to, and also the savings account deposit more than or equal to. Like in class, what I call as the abnormal limit. So you have the abnormal limit in 3 places. Okay. So what are the 11 situations where individual HUF, AOP, BOY, AJP has to file ITR? Number 1, if the GTI add back the 54 series exemptions if it is more than basic exemption limit. Number 2, assessee is an ROR and has a capital asset outside India. Number 3, assessee is ROR and has an agent outside India. Number 4, total deposit in current account in the previous year is more than 1 crore. Then the total deposit in the savings account is at least 50 lakhs. Then total electricity expense in the year put together is more than 1 lakh. Total foreign travel expense put together in the year is more than 2 lakhs. Business turnover is more than 60 lakhs. Profession gross receipt is more than 10 lakhs. Assessee is a senior citizen or a super senior citizen with TDS TCS credit at least 50,000. Or if assessee is not a senior citizen or a super senior citizen, but TDS TCS credit is at least 25,000. So if your assessee falls under any of these buckets, for that assessee, it is mandatorily required to file ITR. Okay. But please don't forget, will you check all this for company and firm? No. Every company, every firm, doesn't matter what their income is, doesn't matter what the electricity expense is. Every company, every firm has to mandatorily file ITR every year. Okay guys, this is about the 9th concept. Then coming to my 10th concept, section 139AA, quoting of Aadhaar number. Now the Aadhaar number has to be quoted mandatorily in 2 places. Number 1, in the income tax return, and number 2, let's say you don't have a PAN right now, okay. You want to make an application for PAN. So in that application form for getting the PAN, in that application form you have to mandatorily quote the PAN. So in these 2 places it is mandatory for every individual to put his PAN. But there are 4 individuals, guys, for whom this Aadhaar concept itself will not apply. Person number 1, individual number 1, that individual who is living in Assam, Meghalaya, Jammu, Kashmir. Point number 2, those individuals who are non-residents. Point number 3, those individuals who are at least 80 years old. And point number 4, those individuals who are not citizens of India. So for these 4 individuals, this whole concept of Aadhaar itself is not going to be applicable. Number 1, individuals who live in JAM, that is Jammu, Kashmir, Assam and Meghalaya. Then individuals who are non-residents, individuals who are at least 80 years, and individuals who are not citizens of India. For these 4, Aadhaar concept is not applicable. Okay. Now see, the next concept is interlinking PAN with your Aadhaar. You have to interlink your PAN with your Aadhaar by 31st March 2022. If you don't interlink by 31st March 2022, then 4 things will happen. Number 1, your PAN will become inoperative. But when will PAN become inoperative? Only on 1st July 2023. Then point number 2, you will not get refund of income tax and all. Point number 3, interest on refund also you will not get. And point number 4, your PAN has become inoperative, which means it is as if you don't have a PAN number. So if you don't have PAN, TDS higher rate will apply 206AA, TCS higher rate will apply 206CC. Okay. Now after 31st March 2022 today, now if you go to interlink your PAN with your Aadhaar, you can interlink, but you will have to pay 234H fees. How much? 1000 rupees. So once you pay this fees, once you interlink your PAN with your Aadhaar now, within 30 days your PAN will become operative again. Okay, so I'll give you a quick revision of this once again. I'll give you a revision of the revision. So listen to me. The Aadhaar number has to be linked with the PAN number by which date? By 31st March 2022. If you don't link it by 31st March 2022, how many things will happen? 4 things will happen. Thing number 1, your PAN will become inoperative. But PAN will become inoperative when? Only on 1st July 2023. Point number 2, income tax refund and all you will not get. Point number 3, interest on income tax refund you will not get. Point number 4, because your PAN has become inoperative, it is as if you have no PAN. If no PAN suffer TDS, higher rate will apply, 206 AA. TCS, higher rate will apply, 206 CC. Okay, so you're suffering, you are having 4 consequences. Now today, if you go and interlink your PAN with your Aadhaar, if you interlink after this date, then in that case you will have to pay 234H fees of 1000 rupees, and within 30 days your PAN will become operative again. Okay, then comes our next concept, concept number 11. This is about mandatory quoting of PAN. Your PAN number, your permanent account number, your PAN has to be mandatorily quoted in some transactions. These transactions, guys, if they come in the examination, they will be straightforward theory questions. Like they'll give you 4 transactions and they'll ask you whether PAN has to be quoted or not. Okay, it will be like straightforward pocketing of 4 marks. No major concept over here, it's just memorizing the numbers. Alright, point number 1, if you want to open a demat account, you have to quote your PAN. If you have to open a bank account, you have to quote your PAN. If you want to apply for credit card, you have to quote your PAN. Then if you want to make an FD or if you want to make a time deposit with BCP, bank, cooperative bank, post office, NBFC or Nidhi company, if you want to make an FD or a time deposit more than 50,000 rupees or more than 5 lakhs aggregate during the year, you have to quote your PAN. Then if you want to sell or purchase any vehicle other than two-wheeler, for two-wheeler you don't have to quote your PAN. Other than two-wheeler, any other vehicle you want to buy or sell, you will have to quote your PAN. First 5 points clear. Once again, if you want to open a demat account or if you want to apply for a credit card or if you want to open a bank account or if you want to make an FD or a time deposit more than 50,000 rupees or more than 5 lakhs aggregate during the financial year, or if you want to buy or sell any vehicle other than two-wheeler, any vehicle if you want to buy or sell, you have to quote a PAN. You'll have to quote your PAN number. Okay. Then I have 5 transactions. In these 5 transactions, if I'm going to make the payment more than 50,000 in cash, only then I'll have to quote the PAN. What are the 5 transactions? Number 1, if you want to purchase a bank draft. Number 2, if you want to purchase foreign currency. Number 3, if you want to make payment for travel to a foreign country. Number 4, if you want to make payment to a hotel. And number 5, if you want to make payment to a restaurant. So it's very simple to remember. Bank draft, then foreign currency, foreign travel, then hotel, restaurant. So in these 5 cases, if you're making the payment more than 50,000 in cash, only then you have to quote your PAN. If you make the payment more than 50,000, let's say in check, then you don't have to quote your PAN. Only if the payment is more than 50,000 in cash, only then you have to quote your PAN. Okay. Then I have 4 cases where where it doesn't matter what is the mode of payment. Whether you're making the payment in cash or not cash doesn't matter. But if the payment is more than 50,000, you have to quote your PAN. 4 transactions. Number 1, debentures. Number 2, bonds. Number 3, life insurance premium. And number 4, mutual funds. So in these 4 cases, if you're making payment of more than 50,000, you have to quote your PAN. Okay. Then we have 2 more points over here. Sale or purchase of securities other than shares. Securities other than shares or sale or purchase of unlisted shares. For these 2 transactions, if the transaction amount is more than 1 lakh, we have to quote the PAN. The mode of payment, the mode of receipt doesn't make a difference over here. If it is more than 1 lakh, we have to quote PAN. So securities other than shares and unlisted shares. What about listed shares? Listed shares we don't have specifically mentioned over here because listed shares anyways you will buy or sell through your demat account only. And for demat account, anyways your demat account is linked with your PAN number, so it will anyways get covered over there. Okay. Then sale or purchase of immovable property. Here you have to quote the PAN if the consideration or SDV, whichever is higher, if it is more than 10 lakh rupees, then you have to quote the PAN. SDV or consideration, whichever is higher. If it is more than 10 lakh rupees, you have to quote the PAN. Then sale or purchase of any other goods which is not covered over here, like for example laptop or jewels. Sale or purchase of any other goods, any other services case which is not in this list. If it is more than 2 lakh rupees, then you have to quote the PAN. Alright, now I'll give you a second revision over here of the important points. Listen to me carefully. Number 1, if you want to open a demat account, you have to quote PAN. Bank account, credit card, easy points these are. Now the FD and time deposit point, I'm not sure if you understood properly. Listen to me. Per FD, if it is more than 50,000 rupees, you have to quote PAN. Per FD, if it is less than 50,000, but aggregate put together in the year is more than 5 lakhs, you have to quote PAN. Now you understood? Let's say per FD 40,000 only. Let's say I made 20 FDs. Per FD is 40,000 only. Okay, 20 FDs per FD is 40,000 only. So total amount is 8 lakh rupees, guys. Okay, now per FD is not more than 50,000, but aggregate put together is more than 5 lakhs. Therefore, I have to quote the PAN. Okay, then sale or purchase of any vehicle, even this is important. Sale or purchase of any vehicle other than two-wheeler, any other vehicle, we have to quote PAN. Then after this is foreign currency and foreign country points are important. More than 50,000 in cash, you will have to quote PAN. Hotel, restaurant, so easy to remember. More than 50,000 in cash, you have to quote PAN. Then the next important point is life insurance premium. Life insurance premium more than 50,000, you'll have to quote your PAN. And lastly, immovable property, guys. If it is more than, if the consideration or SDV, whichever is higher, is more than 10 lakhs, then you have to quote your PAN. All other goods and services, if more than 2 lakhs, then you have to quote your PAN. Okay. Then comes your next point, concept number 12. Here we are seeing that who has to apply for PAN. Basically, it is mandatory for whom to get the PAN number. Number one, every person whose total income is more than the basic exemption limit, that person has to get PAN. Number two, if you're carrying on a business or a profession and your turnover or gross receipts is more than 5 lakh rupees, you have to get a PAN. Number three, if you're a resident non-individual means, like for example, you're a resident company or a resident firm. In that case, if your financial transactions are more than 2,50,000, you'll have to get a PAN. Now, that entity's MD, CEO, director, partner, karta or principal officer, even they have to get a PAN. So, totally 4 people have to apply for PAN. Number one, every person whose total income is more than basic exemption limit. Number two, every person who's carrying on a business or a profession and the turnover gross receipt is more than 5 lakh rupees. Third and fourth point are interconnected. Let's say I have a resident HUF or a resident company or a resident firm or resident AOP, basically any resident who is not an individual, who is having financial transactions more than 2,50,000. That person has to get PAN. Now that entity's MD, like for example, if it's a resident company, then that resident company's MD, CEO, director, they have to also get a PAN. Then let's say if this entity happens to be a firm, a partnership firm or an LLP, then that firm's partner also has to get a PAN. Let's say this entity happens to be a HUF, then that HUF's karta also has to get a PAN. So not only this entity's MD, CEO, director, karta, partner, even they have to get a PAN. Okay, so this was about who has to apply for PAN. Then comes a very important point, guys, point number 13 about defective return. If the return is defective, the assessing officer will ask you to rectify the defect. In that case, you have to rectify the defect within 15 days. Please remember this time limit, very, very crucial. This is defective return. The return has to be rectified within 15 days. If you rectify within 15 days, we will treat it as if it is a valid return. But if you don't rectify within 15 days, we will treat it as if it is an invalid return. We will treat it as if you have never even filed the return. Okay, so there are two possibilities, guys. There's a defective return. Either you rectified within 15 days or you did not rectify within 15 days. So if you rectified within 15 days, we will treat it as if it is a valid return. But if you don't rectify within 15 days, then it becomes an invalid return. But however, there's an exception. Even if you don't rectify within 15 days, okay, after 15 days, if you decide to rectify, sometimes the AO will let you do the rectification provided you're able to give some justifiable reason. So AO does have the power to condone the delay and treat the return as if it is a valid return, even if you rectify after 15 days, provided you have a justifiable reason. So generally you're supposed to rectify within 15 days, but if you don't rectify within 15 days, it will become an invalid return. But even if you don't rectify within 15 days, even if you go to rectify after 15 days, in some justifiable situations, the AO will condone the delay and let you rectify after 15 days also, no problem. Okay. Then comes the 14th point, updated return. See, when do you file the updated return? Only in two situations. Situation number one, you did not even file the ITR, okay? 139(1) due date has lapsed. Even the belated return due date has lapsed. After that, if you want to file the return, only option you have is updated return. Second situation, you want to revise the return. If you want to revise the return, the time limit is 31st December 25, we just saw, guys. But that date has lapsed. After that date, if you want to revise the return, your only option is updated return. So in these two cases only, we file updated return. Now, if you want to file updated return, there's a time limit for this also. The time limit is 2 years from the end of the assessment year. Like in our examination, our previous year is 24-25, our assessment year is 25-26. So what is the end of the assessment year? 31st March 2026. This plus 2 years will be 31st March 2028. So if you want to file updated return, the last date to file is 31st March 2028. Now see, through updated return, government is giving you a favor, guys. Even though your time limit to file belated return has lapsed, even after that, the government is letting you file the return. Even though your time limit to file the revised return has lapsed, still the government is letting you revise the return. So the government is clearly doing a favor on you. So in such cases, because the government is doing a favor on you, government will expect additional income tax from you. Now, how much additional income tax? Listen to me carefully. See, I'll help you understand this with the help of a timeline. Let's make a timeline over here. Let's say we're talking about previous year 24-25. Okay, 24-25, you want to file the return. You did not file the return within 139 date. Belated return time limit will be 31st December 2025. Even till then also you did not file the return. You want to file the return after this. So your only option is updated return. You can file updated return till when? Till 31st March 2028, right guys? So in this period, after 31st December 25, which means 1st January 2026 onwards, after this till 31st March 28, in this period, if you want to file the return, only option is updated return. Alright, now here I'll take the last 1 year. The last 1 year will be after 31st March 2027. In this last 1 year, if you file the updated return, you will have to pay 50% additional income tax. Before this 1 year, that is before 31st March 27, on or before 31st March 27, if you file the updated return, you will have to pay 25% additional income tax. Understanding? In the last 1 year, if you file the updated return, you will have to pay 50% additional income tax. Before that, if you file the updated return, you will have to pay 25% additional income tax. Now, additional income tax is 25%, 50% fine. But 25%, 50% of what? Of tax payable plus interest. Which interest? The 234 ABC interest. Okay. Now, please notice it is tax payable, not tax liability. So, it is tax payable, which means tax liability minus TDS TCS credit minus advance tax. Tax payable number is what you will see. Tax payable plus interest, these numbers into 25% will be your additional income tax, and if you file your updated return in the last 1 year, then 50% of tax payable plus interest, this will be your additional income tax. Okay, then remember very carefully, for 1 year you can file updated return only once. Then always remember, because of updated return, the government should benefit. So if your updated return is a loss return, not allowed. Updated return cannot be a loss return. If because of updated return your tax liability is reducing, gone, you can't file updated return. Because of updated return, if you're becoming entitled for a refund, gone, you cannot file updated return. So because of updated return, the government should benefit, which means government should be having more tax inflow. Only then updated return will be allowed. So if updated return is a loss return, it will not be allowed. If because of updated return your tax liability is reducing or it's resulting in a refund, even that will not be allowed. And also remember, if your original return was a loss return, okay, then your updated return can be an income return, that is allowed. You have already filed the return, let us say, that was a loss return. You want to revise this return, okay, and the time limit for revising has lapsed. So only option is updated return for you. So if updated return is an income return, this will be allowed. But if your original return is an income return and if your updated return is a loss return, that will not be allowed. Okay, so this was about updated return. Two extremely important things over here, the time limit and the additional income tax. Remember, additional income tax is a percentage of what? Tax payable plus interest. Okay, and then coming to one last concept, guys, tax return preparer. Extremely important, listen to me carefully. Totally 4 points you have to understand over here. Point number 1, who can be a tax return preparer? Only an individual who is either holding a bachelor degree, which means he's a graduate, or he must be a CA Inter, CS Inter or a CMA Inter passed. Only that individual can be a tax return preparer. Only that individual who is either a graduate or he has passed CA Inter, CS Inter or CMA Inter, only that person can be a tax return preparer. Point number 2, who cannot be a tax return preparer? An individual who is a bank officer of that bank where the assessee is having a current account. So if there's a person, okay, he is working in a bank, okay, in this bank the assessee is having a current account. So this bank officer cannot be a TRP for this assessee. Okay, so a bank officer who is officer of that bank where the assessee is having a current account, that bank officer can't be tax return preparer for that assessee. Point number 1. Point number 2, a practicing lawyer and a chartered accountant, these people cannot be tax return preparers. Point number 3, who can file the return through a TRP? Only that individual or HUF who is a resident and for whom 44AB tax audit is not applicable. Only such individuals only can get their return filed through a tax return preparer. And the last point, very important point, if your original return was filed through TRP, only then revised return can also be through TRP, which means if your original return was not filed through TRP, if you yourself filed the original return and not through TRP, then your revised return also cannot be through TRP. But if your original return was through a TRP, then your revised return also can be through a TRP. Okay, so 4 points about tax return preparer. Point number 1, who can be a tax return preparer? Only an individual who is a graduate or CA inter passed, CS inter or CMA inter passed. Okay, point number 2, who cannot be a TRP? If you're a bank officer of that bank where the assessee has a current account, then you can't be the TRP for that particular assessee. If you're a practicing lawyer or a chartered accountant, also you can't be a TRP. Then which individual or which assessee can get the return filed through a TRP? Only that assessee who fulfills 3 conditions. You must be individual or HUF, you must be a resident, and 44EB tax audit should not be applicable for you. Only such persons can get the return filed through TRP. But however, if you want to file a revised return through TRP, that is possible only if your original return was also filed through TRP. Only then your revised return can also be through a TRP. Alright guys, so these were all your concepts from your returns of income chapter. The most crucial points over here being number 1, what are the consequences if you file your income tax return late? 6 consequences we saw. You can't carry forward current year losses. Chapter 6A part C you cannot enjoy. 234F fees. Then 234A interest. You cannot opt out of default regime. You will have to file your return as per default regime only, and 10AA tax holiday you will not get. First extremely important point over here. Second crucial point is verification of ITR. Who has to verify ITR? Third important point is who has to mandatorily file ITR. Then mandatory quoting of PAN again is important. These transactions that we saw. And lastly, this TRP concept is also important. Now before I close this session, one last thing I want to discuss with you all. Just one last point guys. 1 minute it will take us. Listen to me carefully. The question says, the question has given all the details of the assessee. Okay, assessee, let's say he's an individual and all his income numbers, everything is given to you in the question, and the question is not telling you which regime the assessee is following. Question is silent. All right, but the question does say that this individual has filed his ITR late. So in this case guys, you will be doing the computation as per which regime? You will be doing the computation as per 115 BAC only. So if they tell you that assessee has filed ITR late, indirectly they are telling you that assessee is following the default regime. Getting my point? Because if assessee files ITR late, he does not have the option of opting out. If he files ITR late, his ITR has to be as per 115 BAC only. So therefore this can be one way in which they are trying to communicate to you what regime assessee is following. Instead of saying assessee is, instead of outrightly saying assessee is following 115 BAC, indirectly they can say that, oh, assessee has filed ITR late. So if assessee is filing ITR late, it has to be 115 BAC only. So your whole computation, income computation, tax computation will be as per 115 BAC. Okay, so this was your entire discussion on your returns of income. So we'll close over here guys. Go and pocket those 4 marks fully in your examination. Not only will you be getting a separate standalone question from here for 4 marks or 5 marks in your examination. In addition to that, this quoting of PAN concept that we saw, right, this can be a part of your case-based MCQs as well. Your 139(1) due dates can be a part of your total income questions as well. So this chapter will help you in multiple places in your examination. So that is it guys. Bye-bye. If there's any other concept, specific concept on which you think you need help, let me know in the comment section. Bye-bye.